Very good morning from London. Generally, the European session so far has witnessed a grind lower in the riskier asset classes, the euro-dollar currency pair dipping to a two-year low at the lows on the session today. Generally, there's been some global growth demand fears just seeping back into the market over the last week or so. We've seen the ECB and the PBOC in China cut rates, allied with some further quantitative easing out of the Bank of England. And overnight, we saw the Brazilian central bank cut rates by 50 basis points, so a record low interest rate for the Selic in Brazil. Also, the South Korean central bank cutting rates by 25 basis points, the first move they've made in 3 years. So the global concerns just emerging back into the European morning. Also, we have the Chinese GDP figures out in the session overnight tonight to come into for tomorrow morning. Taking a look at China specifically, they did release their new yuan loan data this morning, coming in higher than expected. That just produced some slight optimism into the markets, but that was a brief fillip in what otherwise has been a move lower across those riskier asset classes. Also, there was some focus on the ECB overnight deposits, dropping from an average of the last month or so of around 800 billion euros, dropping to approximately 325 billion. Some were speculating this was because of the change in the deposit rate to zero, and therefore the banks being prompted to issue these loans back into the free market, possibly stirring some borrowing from domestic consumers. However, taking a look at the ECB current account, the fall in deposits has been pretty much matched by flows into the ECB current accounts, so it looks like banks have just parked these funds into another ECB vehicle rather than lending to the outside market. Otherwise, it's generally been quiet in terms of data. We've had an Italian T-bill sale for 12-month bills coming in with a pretty low yield, much lower than the previous, but markets pretty unresponsive. We've also just seen a good gilt sales out of the UK coming in with a record low yield for the 10-year, matching the record 10-year low we saw for the US 10-year notes yesterday and the German Bund 10 years. So we've just seen some flows again into the safer assets. Otherwise, market attention will be turning to the 30-year long-end gilts note sales out of the US for $13 billion, and also the weekly initial jobless and continuing claims out of the US. That's enough from me. Hope you have a good trading day.